I've raised capital from TikTok, I've raised capital from YouTube, I've raised capital from LinkedIn. If it doesn't make sense or feel comfortable for you to be on social media, don't try to force it because you're not going to connect with an audience. I don't qualify for most people to invest in, but it doesn't mean that they're not entitled to that information. It doesn't mean that I can't talk to you because you're not my client, you're not my type of investor, because you could be tomorrow. I started Alternative Wealth Partners in 2020 in the middle of the pandemic from my home. And I think at that time, especially with the volatility in the market, there was an increased interest from the retail space. And so when I refer to the retail space, I'm talking about your everyday millionaires looking for other opportunities off Wall Street. 'Cause the markets were going crazy, oil went negative. Like there were a lot of things going on. Like what else is out there? People were trying to Google search alternative investments. And if you've ever tried to do that, you know that there's just an Investopedia article regurgitated 1,000 times. And that's about the extent of information about alts. So I decided to put together Alternative Wealth Partners. It took me about 8 months to put together a portfolio of assets that I had sourced over, basically my career. I reached out to people in my industry and my network. I was like, I'm building this fund. This is what I'm thinking. Who's got deals that fit into this, picture. About 8 months in, I decided, okay, I'm going to launch this fund. I went out to people I didn't necessarily know, but had soft relationships with. These were advisors, these were investors, these were people I'd worked with in the past. And I said, here's my strategy. I want to raise this amount of money. Initially, I wanted to raise 50 million. I ended up closing at 17, and that's just because we generated returns very quickly. I didn't want to dilute investors anymore. But we raised that very quickly because we had this established trust system with people that I had either known or were introduced to. And then their friends and family came in as well. Because I do a lot of investor education, I think it helped people connect with me even though they had no idea who I was. I've raised capital from TikTok, I've raised capital from YouTube, I've raised capital from LinkedIn. So it's just about being able to create a very quick trust relationship with individuals, whether you know them or not. So I'm on TikTok. I think that it's important to depending on who you are, if it doesn't make sense or feel comfortable for you to be on social media, don't try to force it because you're not going to connect with an audience. Everything is very community based now. This is a huge shift from what it was 10 years ago where, investment information or investing in general was kind of an independent task. Because social media exists and because there's these platforms being built, there's more community around investing. People want to lean on other people experiencing the same thing as them. And so when I got onto TikTok, I wanted just to give more information and access to what I'm doing. I don't qualify for most people to invest in. But it doesn't mean that they're not entitled to that information. Because at some point they will be an accredited investor. And I think that everybody should have that mindset. So it doesn't mean that I can't talk to you because you're not my client, you're not my type of investor, because you could be tomorrow. And if I gave you the information today, when you become accredited or when you become comfortable with the concept of investing, 6 figures into something, then you're like, you know what? I want to trust this person because she helped me anyways. And I think that was what was really powerful on TikTok was somebody was watching my content and connecting with me because I wasn't asking for anything. In the midst of 2020, and the reason why I like TikTok and use it in my business is because it is a really good way to find your people. I found my wife on TikTok. I created content, she connected, we had a lot in common, and 4.5 years later, here we are. Building my portfolio for Fund 1 was an interesting task because I liked a lot of different things, but there were a couple projects that I had worked on in the past that weren't ready for investment back then. But at the point that I had decided to create my own fund, they had gotten there. And because I was a consultant and I was working on these businesses and building them up, I took that as an opportunity to create preferred returns from those relationships. So keeping them from going out and raising capital from the public, I was able to structure unique deals between myself and those assets because I was going to come bring in the capital directly. And I built the first fund on some of those assets. And because I came out like very loudly about raising capital, I was exposed to a lot of different unique opportunities that we were able to take advantage of. The diversification strategy was really successful in the first fund. I blended the strategy of front loading the fund with revenue generating hard assets so that we could be patient while we waited for equity exits of more private equity and venture type investments. It was a 5-year fund, so we're 2.5 years in, but we delivered 2% returns in 30 days because of the revenue generated from oil and gas, debt, and some real estate investments, which is what is generating the dividend return for investors. The dividend return in the investors is right around 10%. Those investors have been in for 10 years, but the tax advantage return is well over 30%. Some of the investors who were in at the very beginning as active investors have actually essentially written down their entire investment and received a 10% dividend. I think that we would have been able to generate higher returns if we were a little bit more patient. Because we were targeting double-digit returns, we got really aggressive with deploying. But if we had been a little bit more patient, we could have negotiated higher interest on bridge loans. We could have maybe done one deal over another deal. But when you're raising capital in a very short period of time, it gets challenging to deploy fast enough. And I think that maybe just having a little bit more patience, which is what our strategy is in Fund 2. So Blue Mountain Best is a coffee farm in Jamaica. We own 1,300 acres in Jamaica in the Blue Mountains. And if you're familiar with coffee, Jamaican Blue Mountain coffee is some of the best coffee in the world. It's also the most expensive coffee. And coming from an oil and gas background, I'm a huge commodities person, and coffee is a commodity. So I met the team behind Blue Mountain Best years ago, and they were working on a different project. And so when I went out on my own, I reached out to them because I liked the team and I liked the access to the things that they were doing. So I was wondering what they were working on. We got involved and they said they had bought this property out in Jamaica. They were working on this coffee farm. And so I took the opportunity to go out there. I visited the farm, I visited the team, I visited all the people that were working on it and what their goals were. And the way that we structured that deal actually is that we own equity in the company, but because I like to risk mitigate, we didn't just invest a bunch of money into equity of a coffee farm. We actually mortgaged the land for them, so we technically owned 1,300 acres. They pay an interest and a mortgage payment on that property, and we have a third of the company. So we get to be creative because I'm the only capital in the deal, with the exception of maybe a handful of other investors. Because we're the largest investor in that project, we get to take the most value out of it. And they've been able to build roads and infrastructure, and they're the largest employer in that part of Jamaica and the highest paying employer. So there's a lot of community empowerment going on behind that investment. And it's actually one of my favorites. It is really important for you to be hands-on with your investments. As a fund manager, you should never buy something without looking under the hood. That's how you get in trouble, because if you don't understand the team, you've never been in the same space, maybe seen how they react to the different things that are going on around them, then you don't know how they're going to react when there's challenges within the business. Are they going to disclose those challenges? Are they going to take those challenges out on you? Are they going to take those challenges out on their team? Like, there's things that you have to experience in person as much as possible. Not everybody can go to Jamaica all the time to look at things. But it was really important for me to go out there and see how the employees were treated, what the community was like, how the team worked together with the community, and as if it was just someone coming in and taking over a farm. Because these are people that had their own farms that now they're co-oping with the commercial production. And so I wanted to see what that relationship was like. And it's very important to do all of that due diligence. You can do it quickly. It doesn't take months to have dinner with somebody. I I think Buffett does this a lot, where he just has dinner with someone and then he decides to invest. You can learn a lot from somebody just by being in the same space with them. In the oil and gas space, I did have established relationships in that industry. So from my personal experience of investing in oil and gas and then also working for oil and gas family offices, there's just a lot of relationships there. It's a very small industry. There's not a lot of space between the small operators and the big operators. They kind of all know each other. And 30% of the production actually comes from independent operators. So there's a lot of opportunity there, and we all kind of know each other. And it's about determining who is really big risk takers, your wildcatters out there, and who are more calculated. So my partners in the oil and gas space are more accountants than they are operators. So they have a different perspective when it comes to sourcing oil and gas prospects, because they're looking at it from a banking perspective and less about a, am I going to strike gold perspective. And that's what I really like, because again, that mitigates a lot of risk. It is very hard to break into oil and gas or any industry without relationships, and you have to take the time to build them, because there's bad actors in every industry. Oil and gas has a very bad rap for this, because what's the best way to describe this? Oil and gas has ups and downs, where it becomes very popular to invest in oil and gas with or without experience. And so you saw these moments when oil went to $140 a barrel that everyone was kind of getting into oil in 2014, and then they experienced this massive loss. And then some people came in 2016, thought they knew everything about oil and gas because they were making money, but everybody was making money then in oil. So when they tried that strategy again a couple years later, it didn't work. And so there was also a big popularity around taking tax deductions only in oil. Like if you invest in oil, you can write off 100% of your investment, which is true, but like you don't make investments for 100% losses. And I think that people were so focused on the tax advantages that they missed the point of like, hey, I'm investing in this for a return. So take the time to understand who is the bad and who is the good in every industry, because everyone has a track record in some way, whether they've invested or not. They have a personal track record of who they are as a person. And so you have to do the research there, and find other people that you can rely on for information or like second guessing, getting a second opinion about like, especially in the oil and gas space, is this a good operator? The cool thing about oil and gas is that you're talking about a globally traded commodity that's regulated by the government. So there is a reporting entity in Texas. It's the Texas Railroad Commission. So they have to report to somebody what they're doing. And if they're not reporting that correctly, there's due diligence you can do to back up whether or not you want to invest in one person over another.